I can't even go on a run without Tesla and Elon Musk doing something to ruin the day. Tesla just fired 200 people on their autopilot teams, the CEO of Pinterest just quit, and all the indices dropped like a rock today, giving up the minor rally we started having towards the end of last week. NASDAQ 100 down 2.98%, almost a full 3% leading to the plunge. So what happened? What's happening? And why are there dangers that are becoming more apparent now that we've got to pay attention to? Well, in this video, we're going to talk about that. Just remember, if you want to get $200 for free, metkevin.com/tasty to get $200 totally for free when you deposit $2,000 with their trading platform. All right, folks, first, let's get some background on what's going on. This is important right here, this chart. This is the consumer confidence chart. I'm covering up exactly where we went on this consumer confidence chart, and I've been listening to some of the complaints of some of you telling me that I need to get myself out of the bottom right corner. So that is exactly what I am now going to do. I'm going to put myself right here. How does that look? I think that looks good. All right, yeah. Anyway, okay, so what do we have here? Look at that, near decade low on consumer confidence. Here, the white line is the index of consumer expectations, and the yellowish line is the index of consumer confidence. So these are two different things. Consumer confidence, interest in their own personal willingness to spend money, right? And then consumer expectations are a little different. They're kind of like, well, what do you think is gonna happen in the market? See, like sometimes consumers themselves can be confident because maybe they have more savings, but then when they're asked about the markets, they're like, oh, no, but the markets on the other hand, big problem. And you're gonna see why this is actually starting to become a real danger in the stock market. And no, I'm not just talking about that earnings recession that's looming. That's already starting basically at Nike. We're halfway there. But towards the end of the video, I'll be telling you this particular danger that is in part being caused by this consumer confidence drop that we got today. Pretty bad. Obviously, it's also being, well, we're seeing consumer confidence fall because, well, inflation didn't peak when we thought it would over here. Instead, now this is our forecast, is that inflation is actually expected to potentially still continue to tick up a little bit before we actually start rotating down. But even when we get to 2023 over here, we still expect to be over 6% in terms of inflation. Look at that. Now I'm covering this area. Whatever. We'll zoom in. There you go. Still expect to be over 6%, by the end of the year. And this is a problem. Inflation is becoming very, very sticky. It's hard to get it down. Now, something that's very good, that's starting to be a sign that, okay, maybe we're going to get this actually down, is we are seeing inventory skyrocket, right? This is a chart of inventory to sales ratio. So the way that works is if you sell $100 and you have $140 of inventory, you would have an inventory to sales ratio of about 1.4. Well, take a look where this inventory to sales ratio was in 2020. It was always over here, the orangish line. It was always in, for general merchandise stores, in this sort of 1.2 to 1.3 region here. It's exploded over here towards the end of 2021 and into 2022. And hopefully this finally starts adding to some like downward pressure for inflation. But again, when we combine this terrible consumer confidence with how long it's actually going to take for these inventory levels to push inflation down, people aren't really happy about what's going on. And it's taking too long for even PPI numbers to come down. First of all, here's PPI. It hasn't moved down at all yet. Sure, we've got prices paid somewhat stabilizing here, the pink line. We've got supplier delivery delays slowly starting to inflect down. We've got backlogs slowly inflecting down. But prices paid, the most important one, we don't have the actual inflection point yet. Now, people are still believing that inflation will come down. The problem is, at what cost? And that's why consumer expectations are getting devastated. And I'm going to show you exactly why this relates to big problems for the stock market. We'll explain this, and I'll tell you the big danger right after a message from our sponsor for today's video. There is no reason we should not be using our sponsor today for trading, and that is MooMoo, because they give you what you need for trading, research, technical analysis, or even posting and discussing our investments. Thankfully, today our sponsor MooMoo is here to help consolidate these tasks into an easy-to-use one-stop trading app that makes it simple for traders to do everything we need all in one place. MooMoo allows you to share and discuss your trades with over 18 million different users, where you can share your strategies and get comments on them. And they're now offering all of my viewers up to 10 free stocks and a bonus Lucid stock when you open an account and deposit money using my link down below. I love that MooMoo doesn't dumb down trading either. They just make it easy. They don't need to sacrifice important information, but they finally make it easy. Take, for example, their advanced drawing tools that allow users to use 38 different powerful charts, support for saving and synchronizing charts, and customized color patterns, allowing users to track the movement of target stocks and discover new market trends. MooMoo can also give you real-time quotes so you can be sure the price you're seeing is an up-to-date price. So, get up to 10 free stocks plus an exclusive free Lucid stock today, only when you sign up using my link in the description down below. Again, link is down below in the description to get up to 10 free stocks and a Lucid stock with MooMoo today. All right, folks, this is the break-evens chart. We've seen this before. The 5-year break-even is generally the market's predictor for what the market thinks inflation is going to do. You could survey consumers to see what consumers think inflation is going to do, and you could look at the bond market. This is the bond market's version. This is the white line, the 5-year break-even, the blue line, the 10-year break-even. We've got a very, very powerful trend over here. Like, this is phenomenal. In fact, if you take a look closely here, you can see that where we sit right now on the 5-year break even right here around that 2.8 level, we have not actually seen since before the war in Ukraine. That's very, very, very good. And we had a slight spike after the Delta variant over here where we were higher. And we're actually lower than all of these spikes right now. This is phenomenal. This is very, very good. So we like seeing these break evens come down. So if the break-evens are going down and people's inflation expectations are down, why is confidence so low? Well, because we think we might end up having to push our markets into a recession, whether it's an earnings recession or an actual recession via GDP, to get there. And so what are people finally doing? Well, folks, this right here. I hate to say it, but this is a dirty chart. This is a dirty chart. I don't like this chart. I'm gonna put myself over here. And this is the big danger. This is the point of this video. Take a look at this. When we had our dip in January, what did people do? We threw $5.5 billion into ETFs. These are ETF inflows, whether that's QQQ or VTI, VTSAX, whatever, right? $5.5 billion of inflows right here on the first dip in January. That's back when I'm like, sell. Get it out, right? I bought a chunk here. Obviously, things kept going down since then, so I mean, I did do some saving over here because I also repositioned my portfolio, which obviously you can get every single move I make in my portfolio by checking out the Stocks and Psychology of Money group linked down below. And we even got a little picture of it, right? Yeah, right behind me here. Anyway, so right here in March, we had $42 billion of inflows. Very, very important. Okay, this is when people really went into buying the dip, right? That's great. We also then had that end of March rally, which people also bought. Not so good, that part. Unfortunately, now we're down at these lower levels here, which I've also been buying these lower levels. But there's a difference between me and everyone in the market. And that, folks, is that, well, now all of a sudden people are starting to pull money out of the market. Yes, folks, take a look at this. Even though at the end of May, we had $30 billion of inflows into ETFs, for the first time, we sold this rally off. This last little 6% move up from the bottom that we had in the S&P 500, that rally got sold. We sold the rip, and it was a minor rip, but we sold the dip instead of buying the dip. And $10 billion left the ETF market. Now, that's sad, because if you had, obviously a crystal ball, the best way to actually have done this is the outflows should be here, right? You would want the outflows to be here. And then we want to see lots of inflows over here because the prices are lower, right? But no, people are finally saying, look, can't take it anymore. Consumer confidence is too low. Inflation is too high for too long. We are no longer interested in investing in this market. We're taking our money out. And you know what this is, folks? This is the beginning of capitulation. When we start getting outflows like this, it is the beginning of capitulation. And it's actually really bad news in the short term, but it's also really good news because we need to finally just get people out who are going to be the little paper hand and weenie babies. And look, I know I paper handed in January, but I got back in, okay? Got back in about 60 days later. Do I wish I waited 90 or 120 days? Of course. But hey, point is, rebalance my portfolio. I would have been down another $8 million had I not made that transition. So I'm extremely happy I did, okay? It worked out really, really well. Now, this though, for those of you with cash on the sidelines, this is good, okay? I'm probably in about 2 weeks, I'm gonna be sitting on about 15% of my portfolio in cash. And if this capitulation comes within the next few weeks, right around hopefully we get peak inflation over the next 2 or 3 months, that could be the juiciest buying opportunity. Who knows? Who knows? You still got Wall Street suits saying, oh, you know, we could see a potential bounce before the next earnings season. Maybe we'll get a 38 to 50% retracement, or that's wishful thinking. Over here, I think this is very interesting. This is the Atlanta Fed GDP Now estimate. You know, this is another potential reason for the season. Good news, actually. And what we have over here, if you look at this green line over here, is this here is the 0% line, a little bit above that, what I drew there. And over here, we went slightly negative with real GDP estimates, but we're actually bouncing up off that floor there a little bit, which is good. Maybe some signs for optimism, but we have to balance like these nominal signs of optimism along with these capitulation signs of optimism. We have to balance that with the fact of the matter that we still have ridiculous consensus estimates for earnings, and that earnings recession is going to hit margins at a lot of companies. And this is something, it's going to be tough. It's going to be tough to find companies that aren't getting EPS revisions to the downside or guide to the downside. Personally, I'm looking at SaaS and obviously Tesla, but that's more of a demand-driven thing, that they have so much demand and they're so early in their growth curve, their EPS is going to grow. But SaaS companies could be very interesting during this time, where maybe you don't actually see big EPS misses at some of the SaaS companies. So those are some things I'm going to be paying attention to. Cybersecurity sold off a lot. Communications have sold off a lot. So I think there's some opportunities out there. We've been talking about some of these in the course member live streams and such, but I'm very, like, I want to be as clear as possible, because I think sometimes people get confused. They're like, well, Kevin, a lot of what you're saying sounds like bad news. Yes. And I'm not going to try to profess to perfectly time the bottom. Not happening, okay? Not this kind of market, very difficult to time. So my thing is just a little bit at a time. As I get cash, a little bit at a time, buy. Now, did a little bit of buying this morning, did a little bit of options playing this morning. Check out those alerts if you haven't seen them yet. And yeah, some straddles. We'll see what happens. I'm kind of excited. But anyway, if we get capitulation in the next couple months here, I mean, hopefully sooner than later. That'd be nice. Whew. Things are going to get worse before they get better. But boy, oh boy, it's going to be a good old buying opportunity. My take, at least. Anyway, thanks for watching, folks. We'll see you in the next one. Goodbye.